Hello, everyone, and welcome to our virtual coffee talk with Kevin Jacobs and Kevin DeYoung, who will be taking us through Tax ESG here in just a minute. Just a few housekeeping items before we begin. You can earn 1 CPE credit for attending today's webinar. In order to receive credit, you'll need to remain connected to the webcast for the entire presentation and answer at least 3 of the polling questions. You'll then receive an email within 2 to 4 business days containing instructions how to claim your CPE certificate. Also, at the end of today's presentation, there'll be a course evaluation that will pop up in a separate window upon exiting the webinar. And if you could please take a minute to answer a few quick questions, we'd appreciate the feedback. And with that, I think that's about it. I will pass it over to Kevin.
Great. Thank you so much. And thanks everyone for joining us today. So the topic we have today is a little different than past topics. And what I mean by that is, while we're going to talk about tax and how it relates to a topic, this topic, ESG, has a much greater reach and has much broader implications compared to that of, say, for example, where we talked about the R&D credit or meals and entertainment. This has a implication on any business regardless of the size. And the key thing to think about when I'm going through the presentation is there's not a one-size-fits-all approach to ESG. ESG is something that needs to be customized by each individual company, whether they be a private equity fund or a small corporation or a publicly held corporation. We're now seeing ESG permeate the market, and so companies need to be responsive to how they're going to address ESG. And so with that said, you can see on the agenda, the first thing we're going to talk about is ESG. What is it? And so we're going to level set, what does it mean to be ESG compliant, or to say that I have ESG related goals? Then we'll talk about how ESG is implicating tax, and then also how tax is encouraging ESG. So really, this is a topic where there's a two-way street, where tax is saying, hey, in order to do certain things and be ESG driven, you need to do this for tax, versus as well as certain things say, okay, for ESG purposes, I want to do this, and tax is giving you various incentives. So let's talk about what ESG is. When most people hear ESG, they immediately think of the E, the environmental, right? Environmental stewardship and impact on operations. This includes climate change, greenhouse gases, pollution, air quality, energy use, as well as efficiency. So it's not only just what type of energy are you using, it's how efficient you're using it. What about waste? What about recycling? So that's the big E, right? And everyone says, okay, well, that predominantly focuses on those in the energy sector, but I'm not in the energy sector. Is there more to it than that? And the answer is yes. And that's where we're going to spend a lot of our time talking about today, which is the S and the G. The S stands for social. It's the stakeholders, relationships, and societal benefit. And so here, where you think about that, it includes human rights, diversity and inclusion, safety and health, labor relations, pay equality, supply chain management, community impact. And so when you try to unpack that, there's really a broad spectrum of activities that fit into this S component. How does what you're doing impact the community? Are you facilitating pay equity? What does my supply chain look like? Diversity and inclusion. We've seen an uptick in diversity and saying we're trying to be more of an inclusive environment. This all goes to the S component of ESG. And so when you're focusing on these components, you're actually focusing on ESG. The other thing to be mindful of is the G of governance, which is the corporate leadership and oversight of corporate practices. And while it says corporate in here, it also applies to partnerships, funds, other entities as well. And so it's really a matter of what type of oversight is there at your entity. Is there diversity? What's the composition? What about exec comp? What's the stakeholder engagement? And that's going to be something that's key. We're going to get into it because I didn't say shareholder, I said stakeholder. But now being mindful of shareholders, what about shareholder rights? Is the company being transparent? And transparency is going to be a really interesting question of what does it mean to be transparent? How much transparency do you need to have to be driven towards ESG? What about risk management? What about ethics? So you can see how ESG really touches all different facets of a company and how tax might be playing a role in ESG. And the goal of this presentation is to really highlight, okay, now I have a greater appreciation of ESG as well as the role tax plays. So with that, we're going to open our first polling question. Again, as a reminder, you need to answer at least 3 of the polling questions. The first one is, prior to this presentation, have you thought of the role tax has on ESG? Obviously, when thinking about it, you say, okay, I might have thought about environmental credits. And if so, then yes, you've thought about the role that tax has on ESG. But beyond that, what about the other role that ESG plays? Have I thought about that? And again, as a reminder, there's no right or wrong answers here. Just make sure that you answer it. So while you're answering the polling question, I'm going to go ahead and talk about the government's role in ESG focus. And really, it's really an interesting phenomenon in that if you look at the SEC, the Securities and Exchange Commission, the focus on ESG has really taken to a heightening level starting in 2021. Now in 2021, the SEC has identified as one of its examination priorities climate and ESG related risks. So when they're looking at the filings, they're trying to examine, has climate and ESG related risks been adequately disclosed? On top of that, they've created a task force within the Division of Enforcement to say we're going to actually look at and focus on ESG and climate. Now, obviously, when ESG is a hot button issue, many people rush to market to say, I'm doing a great job in the ESG. This is no different than any other topic where people say, okay, this is where the investors are going. I want to make sure that I'm doing, or I can claim that I'm doing what's going to attract the most amount of money. And so as a result of that, the SEC then issued a risk alert regarding ESG investing. And so let's unpack what that means. The SEC was concerned about greenwashing. Now, it's a funny name, but you could sort of tell what it means. Generally, greenwashing is standing for conveying false or misleading information about how environmentally friendly products are. So I could say, okay, hey, you want to buy this wonderful glass of water. It's the purest of water. I didn't use any chemicals and whatnot. Whereas if you went back to my plant, you could have seen, hey, there's a whole bunch of chemical process in order to clean the water, in order for me to sell it. That would be greenwashing. Now, when it comes to applying greenwashing to ESG, it's really a matter of how transparent are they with respect to their ESG policies, procedures, and practices. And so greenwashing is saying, okay, are they really being forthcoming? Are they really being truthful about their policies and procedures? Or are they just saying, hey, I'm engaged in ESG investing, come invest with me? And so the SEC has said, okay, well, for firms that are claiming that they're engaging in ESG investing, we're going to want to look at their portfolio management. How is their performance? How are they advertising what they're planning on doing? What is the compliance programs that they're putting in place in order to ensure that they're actually doing what they're saying that they're doing? And so it also goes to, okay, what's their investment approaches, as well as how are they proxy voting? And so you can see it's a much bigger picture than just saying, oh, I can say I'm doing ESG and just call it a day. Additionally, the SEC has released a sample comment letter. And the sample comment letter focuses on several different facets that the SEC is going to be looking at. The first one is actually really interesting, which is the extent that the CSR report, or the Corporate Social Responsibility Report, is discussed in the SEC filing. So let's unpack what that means. The CSR report is a report that highlights a company's CSR efforts and the impacts it has on an environment and the community, right? So now we're already saying it's the impact on the environment and the community. It's no longer just the E, right? We're now going into community. And so when you think about that, there's sort of 4 key components associated with a CSR report. There's the environmental, there's the ethical, the philanthropic, and the economic. And the SEC said, okay, well, if you're touting your responsibilities in your CSR report, we want to make sure that A, it's consistent with what you're saying in the SEC filings, and B, we want to know why is it maybe not discussed in your SEC filings if you're disclosing more in your CSR report? Is there something that you're potentially not mentioning to investors? Or are you concerned that if you're subject to SEC scrutiny, then it would be problematic? And so they're really trying to make sure that companies are being as transparent as possible. The second thing they highlighted was, okay, we want to actually have some discussion associated with the cost associated with climate-related projects. And so they're really trying to say, okay, you're doing a climate-related project, this is the cost associated with it. Now the investors have an idea of how much you're really investing into the climate and green energy. They also want to show the impact of climate change on the business's operations, right? So in other words, okay, because of climate change, we're anticipating the following factors. So that way you're really being transparent the role the climate has on your actual business. And lastly, they want to highlight the purchase and sale of carbon credits. So these aren't all of the items in the comment letter, but it's some of them that I thought that might be most interesting. On top of the SEC's focus on ESG, we've also seen the Department of Labor's focus on ESG. And it really has been a pendulum or a tale of 2 different administrations. So in 2020, under the Trump administration, the Department of Labor released 2 different packages. The first was called the Financial Factors in Selecting Plan Investments, which, among other things, required plan fiduciaries to select investments and investment courses of action based solely on financial considerations. So in other words, you generally couldn't consider ESG factors. As a follow-up package, the Department of Labor issued the fiduciary duties regarding proxy voting and shareholder rights, which, similar to the previous package, required ERISA plan fiduciaries to exercise voting proxies and other shareholder rights solely based off of financial matters, which again generally excluded the ESG related matters. So under the Trump administration, the Department of Labor said, no, you shouldn't be factoring in ESG. All decisions are solely financial decisions. Then we had the election, Biden's administration came in, and in March 10th, they released an enforcement policy statement, which said, we are not going to enforce the rules that were just issued under the Trump administration, nor are they going to pursue enforcement action if you fail to comply with these rules. So in other words, the Department of Labor says, even though these rules are on the books, feel free to ignore them. We're not going to enforce them. Go on your merry way. So in other words, we're trying to encourage ESG to be factored into the role it makes from proxy voting as well as investing. In October, they released a proposed rule called Prudence and Loyalty in Selecting Plan Investments and Exercising Shareholder Rights. And so that took it a step further and said, okay, among other things, this is encouraging the consideration of ESG when you are selecting investments, when you are exercising your voting rights or voting proxies. And so this is now enabling them to say, okay, under these rules, if it becomes finalized, it's sort of a 180 from the rules that were issued under the Trump administration. Now, as a general matter, the Democrats fully support the idea of including ESG related topics in investments. However, even some Democrats have raised concerns about the proposed rule. And so many people are anticipating that if it becomes finalized, there will be some tweaks that are made to help address these concerns. So from a general perspective, ESG's focus started principally in Europe, and it has caught on in the US without a doubt. And we'll get into why on the next slide ESG has such a broad range of implications and why so many people have said, yes, ESG is something we need to focus on. In fact, it's really a matter of saying, where should we go with our ESG? And so that leads us to this slide, which talks about ESG scores. And this is really interesting because when you think about it, you see the graphic on the slide, you say, okay, well, everyone, I saw it and I was like thinking of the Olympics, everyone wants the high score, right? And the hard part is there's not one governing body that says this is your ESG score. Instead, there's several companies that issue ESG scores, including, and the list goes on, but some of the bigger names are ISS, which is the Institutional Shareholder Services, MSCI, Refinitiv, S&P Global, Sustainalytics. And what happens when you have this broad range of companies is there's sort of different formulas that each of them apply in different rating scales. Some companies give a number saying, congratulations, you now have 99 or 92 or 80, while others say, okay, you get a letter grade going back to when we were in elementary school. You got an A, a B, a C. And so companies have to look at each individual score and try to say, okay, I understand where I generally fall. Now, because each company has a separate methodology, it's difficult to say, okay, I'm going to focus on increasing my score because there's not a list of criteria that dictates how the score is created. Just like there's not a one-size-fits-all approach to ESG, there's not a one-size-fits-all scoring methodology with respect to ESG. Because what may be important in one sector, for example, for energy, you're going to focus on, okay, what are you producing? What is your carbon emissions? For another business, that might not be as much of a factor. And so there's numerous data points, numerous ratios. It goes into a lot of analytics, but they also look at director profiles, shareholder meeting results. What is the business segment? So what businesses are you engaged in is going to help impact what is the weighting that's going to go to all the various factors. What are the company's policies, programs, performance history, governance metrics? How are they making sure that they're complying with what they're trying to do? As well as, okay, let's look now at what's the time horizon of the risk and the opportunities that they have, and really weighting each item such that no industry is the same, and really appreciating the intricacies associated with the business. With that said, the scores generally come out in line, so you won't have a score where one company says, okay, I'm all the way up here, and another one says I'm all the way down here, but it gives you an idea that there are several companies that are out there giving scores. Now, I mentioned that ESG started generally in Europe, but it's grown momentum. Let's talk about that. You can see on the slide here, I've listed two of them, which is the Business Roundtable, and that dates back to 2019. And you're saying, wow, 2019, that's been a while. Why are we talking about that? But it really was a fundamental shift. And the fundamental shift by the Business Roundtable was 181 CEOs signed on to a new statement on the purpose of a corporation. And it's committed them to say, we're going to focus on all of their stakeholders. Right? Normally, historically, it's always been the goal of a corporation is to make the most for its investors, particularly publicly held companies, right? So we need to generate value. But now, under this purpose of a corporation, it's become much broader. And what do I mean by that? So for just looking at the shareholders, they say, okay, on top of creating value, we want to provide transparency. We want to have effective engagement. We want to listen. What about other stakeholders? Well, for customers, we want to make sure that you're meeting or exceeding expectations. Now, obviously that makes sense, right? I mean, if you want to stay in business, you want to at least meet the expectations of customers. Otherwise, the customers aren't going to be there. But what about the other stakeholders, which is employees? Well, okay, what do you want to do for employees? You want to compensate them fairly, right? There's been a lot of discussion in the country as far as what is a minimum wage, what is a minimum working wage. You want to provide important benefits, training, diversity and inclusion. And I'm literally lifting this from the new statement. So this is what the CEOs agreed to. It's not something that I'm just rattling off. And so really you could start seeing what the corporations are saying. They're taking a much more holistic view, especially when you consider the next two stakeholders, which is they said, okay, well, with respect to our suppliers, I want to deal with them fairly. I want to deal with them ethically. And so really it's a matter of not saying, okay, well, I'm big corporation and you're a small supplier, so you're going to bend at my every whim. You want to make sure that you're treating all of your suppliers fairly and ethically. Additionally, the last stakeholder is really the one that really is enlightening, which is the community. And so now these corporations, not to say that they haven't done it before, but in writing, they're saying, we're going to focus on the community that we're in. How do we support the community? As well as how do we protect the environment? So they're really taking this holistic view of, I'm looking at just all of the stakeholders, and I have to consider the broad ramifications of my actions. And you're saying, okay, public companies, great, got it, but I deal with private equity. That doesn't apply to me, and not so fast, because you see there's the principles for responsible investment, and with regards to that, more than 500 private equity funds have signed on to the principle for responsible investment. And as part of that, it includes a commitment to incorporate ESG issues into the investment analysis, decision-making process, and ownership policies. We recently saw a Global Sustainable Investment Alliance come out with a report that said from 2016 to 2020, the global ESG investment, the assets under global ESG investment, has increased by about 55%. 55% in 4 years. And they're also predicting that by 2025, more than 1/3 of the global assets under investment are going to be ESG related. And so you can see, even in the private equity space, they're seeing a great movement towards ESG. So let's talk about the implications. Generally, companies that are engaged in ESG generally view it as saying, okay, well, good corporate or private equity hygiene is fulfilling what they view as basic ESG, whatever that means to them. But for the competitive edge, it's those that excel. So let's talk about why they want to. And you can see on this slide that there's really 4 different categories that companies focus on, or the implications that ESG has for them. There's the financial, the public, the talent, and the value chain. So let's unpack that. Let's look at financial, right? Everyone says finances drive the world. Let's see what it means. Well, let's first look at investors. Well, companies that engage in ESG or have higher ESG scores can trade at higher values. There's been studies that have suggested recently that startup companies that have higher ESG scores are more likely to stay in business as opposed to having to fail. From a private equity standpoint, ESG related funds can potentially raise capital more easily, or those that have portfolio companies that are engaged in ESG can sell those portfolio companies at higher values. So you can see just the financial aspect. From a pure monetary standpoint, companies are driven to start focusing on ESG. But there's more, because here we have the lenders, rating agencies, insurers, and really ESG is starting to be factored into the credit and risk profile. Now, while it has always been to some extent, it's really taking a forefront motion, and that really means that it's being integrated and can have an impact on interest rates, insurance premiums. So again, financial costs to the company is being factored in. And in fact, later on in this presentation, we'll talk about various ways that ESG can be factored into certain types of loans. You look at the public, right? There's a greater interest and attention to ESG related items. The community is involved. When does the community want certain employers to come in and set up shop, or where they want their headquarters? The media, government agencies, what type of relationship do you have with these government agencies? Talent. We've talked about in the past that the talent market is really, really tight. And so people are looking for good, high qualified candidates, especially because of the very tight market. Most of the marketplace is going to be consisting of millennials and Gen Z employees. And so when you think about that, you have to ask, what do they want? And they generally are looking to work for a company that has strong ESG policies. And lastly, value chain. We have customers and suppliers. Customers, it's really easy to see this. We've all seen the cancel culture that's out there. If someone participates in something, we say, okay, we don't want to be engaged with it. Let's try to cancel them. Well, that right there is part of the value chain. Are you doing something that people like or don't like? For example, we saw as a result of the Russian situation with Ukraine, you're seeing a lot of bars and as well as state governors sort of say, okay, we want to try to limit or eliminate the use of Russian vodka is one of the big things. So now from a customer standpoint, those actions are now having economic effect. You could see it on the supplier side. The suppliers are going to want to deal with companies that are going to treat them fairly. So we've talked about, okay, on the financial side, we could bring in the investors. We've talked about the SEC saying there's a risk alert associated with it. So let's really talk about the three different types of investing that might be involved. There's the ESG investing, which you can see on the slide is focusing on investing in companies that are focusing on ESG, which is a mouthful. But in essence, you say, okay, I want to do ESG investing. So I want to invest in a company that says we're doing our best on ESG. Now that could be investing in an ESG focused fund. That could be investing in a company directly that has high ESG scores. The other flip side of that is, okay, maybe we can invest in a bad ESG actor with a view to actually turn them around. And so you could see how ESG plays a part, but obviously, if you're going that route, you're going to have to make sure that it's within your procedures, within your policies to say, we are trying to make this investment for that reason. We also have socially responsible investing, which focuses on investing based on the investor's values with an aim to generate social change. So what does that mean? Avoiding companies that engage in certain activities or businesses. So you can hear some investors saying, I don't want to invest in a company that engages in what's quote unquote sin businesses, right? Or you can invest in companies that support certain causes. I'm very happy that Corporation X supports whatever cause is near and dear to the investor's heart. So I'm going to put money there. The last one is impact investing, which focuses on investments that have a direct connection with investors and underlying goals or values. So for example, I believe in climate change, and as a result of that, I think we should have more trees planted every day. And so therefore, I'm going to take my money and I'm going to invest in forestry projects, or I'm going to invest in low-income housing projects. So therefore, you could see that direct correlation. It's sort of a more direct investment, but all of these are sort of under the umbrella of ESG. So with that, we're going to open up our next polling question, and this will be fun to say, I believe taxpayers should pay their fair share of taxes. And I'll really be interested. I wish this was a conversation of sort of a fireside to say, okay, that's great. You should pay your fair share of taxes. Even if you said yes, I would love to know, what does it mean in the sense of how do you define fair share? So at some point, if you want, feel free to add it in the comments. I'll definitely be interested in seeing them after the webinar, or feel free to reach out to me as having a conversation about what does it mean to have fair share. While you're answering the question, we're going to go to the next slide, which talks about tax governance. And when you see it, you'll see that we're actually going to talk about fair share, which is, as part of ESG, one of the things that I talked about was transparency, right? Transparency is key. Well, when you think of what transparency entails, you say, okay, transparency means, okay, I need to disclose how much taxes I paid. And normally in the realm of taxes, it's also how much tax did I collect and remit. So therefore I could say, look, I'm also doing my part. So for example, sales tax. How much tax did I withhold? And so you could see that's the easy part. Although there's questions, right? Do I look at country by country? How segmented do I have to provide the information? Do I look at it and say, well, based off of this industry? So if I have a multinational corporation that has, okay, I'm engaged in 8 different product lines, yes, I need to have it broken down by the product line. But that's the quantitative, right? That's sort of the easier. I can see what it means to be transparent. But let's talk about the qualitative. And you could see as part of this, I included the reference to greenwashing and fair share. What does it mean? What is it? What role does it play? And for those that are interested, 87% of you said, yes, it is true, companies should pay their fair share. But again, what's fair share for me might be different than what's fair share for you. And so that's sort of the hard premise of sort of identifying what is fair share. And this gets to the qualitative measures. And I really want to stress before going into some of these, there is no one size fits all. There's not like you have to do X, Y, or Z. As well as some companies are very specific and they identify some, if not all of the factors I'm about to go into, versus others just sort of take a broad approach and say, okay, we're going to be compliant with tax laws. But the first step is really the establishment of a tax strategy and principles. And that includes paying your fair share and public disclosure. So you sort of say, tax strategy and principles. Okay, what does that mean? How do I disclose it? If you go onto the internet and you do a search for tax strategy and principles and you type in your favorite companies, chances are you will actually see documents that say, this is our tax strategies and principles. You're starting to see some of that in the private equity funds as well. So that way the investors who are going to invest their money in their funds actually say, okay, I understand what they plan to do. But in essence, what it does is it elevates tax to the board of directors or managing partners or directors, right? The role of tax within the company becomes elevated, including publicly saying, who does the head of tax report to? And it's really putting the onus on saying, okay, hey, board of directors or managing partners, managing directors, you need to pay attention to this. This is now on you. You're making sure that you're doing exactly what you say you're doing. And so what are various components? Well, clearly one of the easiest ones to say is compliance with tax law. But what does that mean, right? So again, some companies just take the view of saying, we're going to comply with tax law, or they break it down into another heading like, okay, we're going to file all tax returns that are needed, or tax compliance, or considered reporting risk. And so are companies going to, for example, focus on the letter of the law, or are they going to follow the letter and the spirit of the law? So you can see how there's various permutations and degrees of how companies want to implement this. Then we could say, okay, how are they going to manage tax risk? This includes tax controversies. Are they hiring knowledgeable employees or hiring knowledgeable outside providers? How are they treating intercompany transactions? Are they using arm's length principles? Are they saying, you know what, it's intercompany, we really don't have to worry about it? How do they plan to address tax legislation, right? We've talked about BBBA. Well, what was the plan the company had in order to address the ramifications BBBA would have had on their company? As well as when they're thinking about tax planning, what view do they have towards the interpretation of the law? Right? When we think about practitioners, they always say, okay, well, I'm at will, I'm at should, I'm at more likely than not, I'm at substantial authority, reasonable basis. And they throw around these terms. It's a opinion speak, but it goes to how likely do you think, or how strong of an argument can you make that the position that's being taken is the right position? And so some companies are publicly saying, we're not going to take a position that is not at least X, whatever X is. And so part of this is when talking to companies about ESG and the role tax has in ESG, it's a matter of talking to them and saying, let's think about what are the implications of the decisions you're making. What do you want to do? What does this represent? Right? And then you start thinking about, okay, now let's talk about transactions, because transactions happen all the time, right? I mean, you see the M&A activity still ongoing. And so it's involving tax in the M&A at the outset. You're not engaging or considering whether or not you'd be willing to engage in a transaction solely for tax benefits. You know, an example is, okay, well, I'm going to do this in order to possibly avoid the establishment of a PE, which is a permanent establishment, or I'm going to route it this way to avoid withholding tax. Some companies say, I'm not willing to engage in transactions solely for a tax benefit. Others say, no, there has to be a business purpose associated with it. Also, what is the role of tax havens or low tax jurisdictions? Am I okay putting an entity in that jurisdiction? Why am I putting an entity in that jurisdiction? So some of these tax strategies and principles are rather detailed and give out, a high level view of saying, I'm going to do X, Y, or Z when it comes to this. And others say, look, I'm going to be compliant. I'm going to pay my fair share. And lastly, you have the relationships with tax authorities. What is the relationship you have? Are you being transparent so that if you made a mistake, they could say, okay, look, this company has always been transparent. They're doing the best they can. This must be a mistake, as opposed to being a highly aggressive taxpayer in which the tax authorities say they're always trying to get away with something, right? It's that approach, it's that relationship, it's the transparency that really kicks in. So let's now talk about examples where ESG implicates tax. And so the first two we're going to talk about is business structuring and executive compensation. In business structuring, we have three that are listed: supply chain analysis, legal entity rationalization, and transfer pricing analysis. And they really go hand in hand, but they're also really different. So let's talk about supply chain analysis. Supply chain analysis is the process by which a company transforms their operating models and supply chains for growth, right? So what does that really mean? They say, okay, in looking at this product, how did I go from A to B? What are all the inputs? Where did they come in? Where did they come from, right? And as part of this process, you could streamline your supply chain. It reduces economic disruptions due to climate and other factors like the pandemic, realization of cost savings. But why is this needed? Let's think about the recent examples that we could think of. During the pandemic, the number of boats that were outside the port delayed coming in impacted US manufacturers because they couldn't get the parts that they needed into the US. If it was manufactured and if the suppliers were within the US and the parts were in the US, then there wouldn't have been that issue. So that's part of the supply chain analysis. And I'm not saying that you have to do that every single place, but it's just giving an example of where and how does it become relevant. You can also see this, for example, where we had the recent shutdown on the bridge between US and Canada because of the truckers blockade, right? If you were trying to get your goods into Canada or trying to get your goods from Canada and you were trying to cross the bridge, that would be rather difficult and you can have delays. How do you factor all of that in? And so really when you're thinking of supply chain analysis, You're thinking about overall supply chain, you're looking at trades and customs, information technology, how much sharing, what is the real-time analysis you could do, and looking at it from an ESG perspective, right? It's the community focus. You're potentially looking at using quote unquote local suppliers. You're looking to make sure that you're paying your fair share of taxes. I'm not going to route it the long way around in order to circumvent a certain amount of taxes. Again, some companies are comfortable doing that, some companies aren't, but this is all part of the supply chain analysis to determine how can you potentially make your goods more efficient. Let's talk about legal entity rationalization, which is, it's unlike the supply chain analysis, which says, okay, I'm going to look at all the different inputs in my process. I'm going to actually now take a holistic view. I'm going to take a step back and say, what does my org chart look like? Why do I have these entities set up? And so really it's a matter of right sizing the entity chart. And so this goes to tax transparency, as well as paying your fair share. And the benefits of legal entity rationalization, and I've spoken on this a lot, has been, okay, you can have a cost savings from a reduction of entities, right? Generally, when you look at the cost of maintaining an entity, it's generally about $25,000 to $50,000 a year because of all the tax filings, the back office administration, financial reporting, legal compliance, and so forth. And so merely eliminating a box or an entity on the structure may actually give rise to cost savings. But what else does it do? Potentially impacts tax leakage. It allows for a more efficient development of tax strategy, right? Because you're now actually saying, I can implement controls. This entity is doing X, and as a result of it, here's my control with respect to it. Fewer entities result in increased transparency. It also results in increased corporate governance and accountability because you're really able to focus in on saying, okay, this is what this entity is here to do. Now I understand it's that role, it's that function. Here's the controls I put in place. Again, it's not a matter of saying having a whole bunch of entities is not the right answer for a corporation or for a fund. It's a matter of making sure that there's an appreciation for why is that entity here. Additionally, it also limits transfer pricing risk, which is transfer pricing is a process by which companies evaluate the arrangements between related parties, right? So normally it's based off of a fair market value standard. So we're making sure that companies are paying their fair market value or their fair share. Exec comp sort of ties in on this because you're saying, okay, we're trying to streamline our company. We're trying to streamline our process. What can we do? Well, you want to make sure that obviously executives are paid a fair compensation, but you also want to incentivize them to engage in ESG activities and achieve ESG results. So what are some of the considerations? Well, if you're a publicly held corporation, is the amount you're paying going to be deductible, or is it going to be subject to the 162M limitation? What about changes to the exec comp? Is that possibly going to bring up concerns under, for example, 409 Cap A, which we could have an all-day seminar on, or possibly 280G, which is the golden parachute, right? In the sense of if you change, what will happen on an exit? Because when you're planning to sell your ESG-related company, you're going to say you're getting more value. You want to incentivize your executives. Does that mean it's going to impact your golden parachute calculation? And so it's really important to keep this in mind. Now, the next slide sort of highlights, we talked about the role that investors have. We now have the role that lenders have, and you can see that there's things called sustainably linked loans, bonds, and derivatives. And at a high level, what this is doing is it says the people that are engaging in these relationships take a step back and say, I want to incentivize you to engage in certain activities. So there's a KPI, the key performance indicator, which is an overarching big picture goal. Like, okay, carbon emission, we want to reduce carbon emission. SPT, the sustainability performance target, is, okay, what reduction do I want to have? It's the actual, in order to accomplish your goal, you have to do X. Well, in determining that, it has to be based off of the issuer's own performance, as well as the peers or reference to science. And so they say, okay, well, if everyone else is reducing by 5%, is it really a great thing if you're only reducing by 2%? Well, it depends on what the parties are doing. If you've been going up and everyone's going down, a 2% reduction might be what they're encouraging. The impact of that, though, is if you actually meet the SPT, then you get a benefit, right? In the case of SLLs, you could get a reduced interest rate. In the case of SLB, similar. And the SLDs, it decreases the counterparty's payment. On the other hand, if you fail to meet it, there's penalties, right? So the amount you're going to have to pay to borrow might be different. Now, there's nuances associated with it. There's a bunch of tax questions associated with it, including for the SLLs and SLBs, how do I calculate the yield? Does this amount to a contingent payment debt instrument? For the SLDs, well, is this a notional principal contract? So it's sourced by reference to the recipient. So in other words, if the derivative is entered into between a US company and a foreign person, okay, well, if it's a notional principal contract, it would be sourced by the recipient, so the foreign person, so it would be foreign sourced. But if it's not an NPC, you have to say, well, is this generating FDAC, fixed determinable annual and periodic income? So then it's sourced by the payer, so it would be US sourced and therefore subject to US withholding. So you can see there's a lot of tax questions that are here. Being mindful of the time, we're going to go to the next polling question, which is, would you like to be contacted by A&M to discuss your company's approach to ESG, including how tax can play a role, yes, no, or not applicable? Being mindful of the time, I want to make sure that I hit what everyone was anticipating us hitting, right, which is green energy. Today, we actually got like late breaking news, right? The UN report from the Intergovernmental Panel on Climate Change was released, and it highlighted the need to address climate change. And so you can see that any incentive that there is for green energy is going to be in line with ESG, right? That's big E, environmental and ESG. And so there's 3 different credits that are really worth noting. There's the carbon capture credit, which is a credit to capture and dispose, injection, or utilization of carbon dioxide. There's the ITC, the investment tax credit, which is a one-time credit based on the basis of the property used to generate green energy, which generally focuses on solar. You have the PTC, which is wind energy, and so it's based off of the amount of actually energy generated that's sold to an unrelated person. Now, each of these credits has really fine line details to make sure how do you calculate it and whether or not you qualify, as well as there's several hurdles and sunsets. And that's the reason why all eyes are looking to Congress, because as part of BBBA, they were looking to address some of these credits and expand it into other areas, including electric vehicles and the like. But now with BBBA on hiatus, people are looking to Congress and say, okay, how can we incentivize companies in order to do these green energy production? With that said, it's also important to note that many developers that do green energy can't really benefit from the credits they generate because of taxable income limitations. And so this leads to investment by other companies, which is exactly what companies are being encouraged to do, is to make investments in ESG related activities. Although to maximize the potential credit, you really need careful structure. And so there's several different examples. My firm has put out a client alert associated with this, where you could see there's discussions about various structures that can be used, ranging from flip partnerships, inverted leases, sale leasebacks, all of these different structures to help encourage investment in the green energy space. Additionally, there's commercial building energy efficiency deductions, which really, as it sounds, is, okay, do we have energy efficient property being placed in service? If yes, then we want to actually have it put in place. The other example of where tax is encouraging ESG is, you can look at, again, the direct investment in activities. So for example, affordable housing. There's a credit based off of the qualified basis of qualified low-income property. Historic rehabilitation, which is saying, okay, are we taking into account qualified rehabilitating old buildings? The last two I want to take a minute and talk about, I'll go in reverse order, which is the R&D credit. We've already talked about this, right? We've talked about the implications it has for the ability to file the claims, but R&D can be used in line with ESG because you're actually doing research and development activities that are going to support the community, support the greater good. So that's why it's on the slide, to be mindful of ESG. But WOTC, which is the Work Opportunity Tax Credit, is something that many clients don't necessarily immediately think of. This really goes to the community aspect of ESG, and the reason why is WOTC is a credit for a portion of the wages paid in the first year of hiring an individual that's a member of a targeted group. And so when you think of a targeted group, you say, well, what does that mean? Well, that can include certain veterans, it can include certain felons, and so really you're making an investment in a group of people really trying to help out the community while they're also giving you incentives. And so it's really important to think about, well, do I qualify for the Work Opportunity Tax Credit? Our credits group spends a lot of time working with clients to say, okay, let's now try to figure out, do you or don't you qualify? And a lot of them are saying, okay, for those that qualify, it's a surprising amount that they're actually able to benefit from. So it's really a win-win because tax, right, this credit is encouraging you to hire people in the community, right? And that's the reason why it's the targeted group, which is part of ESG. So with that, I thank you for your time. I'm going to turn it over to Kevin DeYoung to help show us how Answer Connect can give you further information on some of the topics that we talked about.
Thank you, Kevin. Am I up on screen? Can everybody see CCH Chancellor Connect?
I see your screen.
Excellent. Yeah, I just thought I'd jump in right here and follow up exactly on what Kevin had been talking about regarding the Work Opportunity Tax Credit. As we take a look at this within CCH Answer Connect, I think it's really important to understand that as we built this tool to assist in doing tax research, we really want to focus on a couple of different areas. First of all, being able to take this current tax information and make it actionable. Kevin talked about the energy production costs and how that is going to have some impact. We're waiting for additional guidance, and we're really excited about how we're going to be able to present that information to you outside of just giving it to you as part of a standard research. I'm going into a code section under, section 48, for example, to find out what it means. But how do we push that content to you to allow you to take a look at it and then dive further into the understanding of what that's about? So what I'm going to do really quickly here is I'm actually going to run a keyword search for the Work Opportunity Tax Credit, if I can spell here. And we've got our suggested search. I'm going to scroll down and grab and run a search really quickly on that Work Opportunity Credit. We have several different ways of presenting the information to you. We have newly curated topic pages where we can go into a deeper dive specifically on the tax credit. And we will get there in a moment. What I really wanted to focus on was the actionable component of when this came out, when the extension was announced. And I'm going into my news section, and we actually have a feature now called our Client Impact Event. And what we do here is any significant legislation comes out, if there's law changes that are going to impact a large number of people, we want to be able to present this content to you in a manner that allows you to see what the impact is, and then move it forward, whether it's to your clients or whether it's to you as a corporation. How do you best take advantage of that? So this is how the client impact information works. We're going to give you an overview, and as Kevin had mentioned, it talks about the targeted groups that begin working prior to a given date, and what some of the requirements and what some of these stipulations are. If there's forms you need to be aware of, we're going to give you that information as well. I'm going to scroll down here a little bit. We talk about the effective dates, obviously January 1st, 2021 for this one as it rolls through for the next 4 or 5 years. But what's important to see here also is we started to tie together all the different areas of the tax research process that you may need to follow as you go through to determine whether, first of all, you qualify for this, but secondly, how do you actually implement it? And as part of that, we have a link into our topic page, We'll get into that in a moment, where we just go deeper into the specific area to give you additional guidance, additional recommendations, and just things that you need to know. But we've also then taken the code section, as Kevin had mentioned, regarding this credit, code section 51, and we pull you all of that information together for you, as well as communication tools, client letters, anything else that's out there that you may need to use to implement this process. So for sake of time, I'm actually going to jump directly into the topic page related to this credit specifically. And again, you'll see a very similar layout where we're going to go into that deeper dive into what the work opportunity credit is all about and some of the information that you need to know. Scrolling down into this page a little bit further, are there specific areas that you need to look at? What are the credit qualified wages? What are the targeted groups? Are there certification requirements that you need to be aware of? We're going to pull that information all to you, for you, into this single location. We talked about the code section. We've also brought it here as well. Any tools that are out there that we may need you to be aware of, we're going to give that to you. So as we continue walking through the research process, I do ultimately need to get into the code section to have my basis of my opinion and where I'm going to go with this. What we've now done here is what we call a 360 view into this code section specifically, where we have our complete code section, the IRC. We then give you access to all regulations tied into this code section. Again, working from a left to right format in the research process. Then giving you the CCH explanations, our interpretation of what code section 51 is all about. If there's any cases, administrative guidance, annotations, rulings, all of that content is also then going to be presented to you here. Forms and instructions are also available. Again, we talked about some of the tools on the topic page, but we have those available for you here as well. And finally, if you do need to get into a federal state comparison, what is my home state or the state that the activity is taking place in? What are they doing in terms of the federal provision? Are they following it? Are they modifying it? Are they decoupling completely and they have their own rules? Again, just allowing you to tie the entire research process into a single research tool. So that's a quick overview of what we have for CCH Chancellor Connect and how we actually discuss all of that. But I also wanted to take a quick jump over to our accounting research manager. I know as Kevin started this off, he began with the SEC's information and guidance regarding this topic. And I think what's really important is we actually produced a closer look, ESG and the SEC disclosures. By simply opening this up, we have created and put together a document that gives you a great overview of what the SEC and the ESG have in common, what they're legislating, what they're looking at. It's a great document. I think one of the first sentences here is there's been more activity in the past 10 weeks than there has been in the past 10 years regarding ESG. And as this continues to develop in just the world we're living in, we know that there's going to be a lot of guidance by the SEC. Our accounting research manager is a tool that will allow you to keep current in terms of what the requirements are, what the suggestions might be, what the disclosures need to look like, and everything related to that piece as you get into the disclosure requirements by the SEC. So again, two great resources available to you as it relates to ESG, both on the accounting side as well as the tax side. And with that, Jill, I'm going to pass it back to you for the final polling question.
Okay. Our final polling question is, would you like a more in-depth demo or further details on the resources and tools available on CCH Chancellor Connect? And we'll give about a minute for everyone to answer that question. And just to let everyone know, this is the final polling question. And as everyone's answering this will wrap up our virtual coffee talk for today. Just a reminder that upon exiting, there'll be a pop-up window with a few quick questions regarding the course evaluation. So we would appreciate your feedback if you could answer a few quick questions regarding the course, and we'll probably give it a few more seconds here for this final polling question. All right, well, thank you for attending our virtual coffee talk, Tax ESG. It's as easy as ABZ. Thank you for attending. This concludes our presentation.